All right, today we're jumping right into a really fascinating pattern called the Harami. It's a powerful two-candle signal that can give you a heads up that a big shift in the market's direction might be just around the corner. So let's get into it.
Think about it. In the world of trading, getting even a small hint that a trend is running out of steam is a massive advantage. And that's exactly what the Harami pattern is all about. It's designed to give you that early warning.
Now, the name here is super interesting. You might think it's a Hindi word, but it's not. Harami is actually an old Japanese word that means pregnant. And once you see the pattern, it makes perfect sense. You've got this large mother candle and a smaller baby candle tucked right inside it. That visual is everything.
Okay, so there are two types of Harami. We're going to start with the optimistic one, the Bullish Harami. As you can probably guess from the name, this pattern shows up at the bottom of a downtrend, and it's a signal that prices might be getting ready to climb. So what exactly are you looking for on your chart? Well, first things first, you need to be in a clear downtrend. Then you're on the hunt for a specific two-candle setup. The first day, let's call it P1, is a long, bearish red candle, looking like the downtrend is still in full swing. But then on day 2, something different happens. You get P2, a small blue candle, and its entire body is nestled inside the body of that first red candle.
And this really gets into the psychology of the market. You see, after day 1, the bears are feeling great. They're in total control. But on day 2, the market opens higher than the previous close. That is not what they were expecting. It starts to create a little bit of panic among the sellers. That small blue candle might look tiny, but it's enough to get buyers interested and make those confident bears pretty nervous.
Okay, so you've spotted one. How do you actually trade it? Simple. Once you've identified the pattern in a downtrend, you have a choice. If you're a bit of a risk taker, you might jump into a long position right around the close of that second small blue candle. If you're more cautious, you can wait for the next day to confirm the move, hopefully with another blue candle. But, and this is crucial, you always set your stop loss at the lowest low of the entire two-candle pattern. That's your safety net.
Let's look at a real-world example here with Axis Bank. So on P1, we see that big red candle closing down at 8:15. But look at P2. It's a small blue candle that opens at 8:24 and closes at 8:35, completely inside P1's range. A risk taker would probably get in around that 8:35 close. And the stop loss? You'd place it at the absolute lowest point of the pattern, which was 8:10 on that P1 candle.
All right, let's flip the coin and look at the other side, the bearish Harami. This is, you guessed it, the exact opposite. It shows up at the top of an uptrend and warns of a potential drop in price.
The anatomy here is a perfect mirror image. First, you need a clear uptrend. Day 1, P1, is a long blue candle, which tells you the bulls are firmly in charge. But then, on day 2, P2, is a small red candle, and its body is completely swallowed by the body of P1. This is a big red flag that the upward momentum is hitting a wall.
And the trading setup is just as you'd expect, a mirror image. Find the pattern at the top of an uptrend. A risk taker can short the market near the close of that little P2 red candle. A more cautious trader will wait for another red candle the next day to confirm. And your stop loss? This time, it goes at the highest high of the two-candle pattern.
Let's check out this example from IDFC Limited. P1 is a nice, strong blue candle. Then P2 opens a bit lower and forms that small red candle, right inside P1. If you're taking this short trade, your stop loss would be set at the highest high of the whole pattern, which in this case is 129.70.
So let's just recap that side by side. The bullish Harami happens in a downtrend and signals a potential move up. You'll see a red candle, then a blue one. The bearish Harami, that's in an uptrend, signals a potential move down, and it's a blue candle followed by a red one. It really comes down to location and color.
Okay, now for the really important part of any strategy, the reality check. No pattern is foolproof, so we have to talk about the common traps and false signals that can trip you up.
This is the million-dollar question, isn't it? Can you just spot a Harami pattern and bet the farm on the trend reversing every single time?
And the answer, in no uncertain terms, is no. The Harami pattern can be incredibly useful, but its reliability depends completely on the bigger picture, the overall market context.
So why do they sometimes fail? Well, it usually comes down to two things. The biggest mistake people make is seeing a Harami pattern when there's no real trend to begin with. If the market is just choppy or moving sideways, the pattern is basically meaningless. The second reason is, well, just randomness.
Sometimes you can have a perfect setup and the market just decides to go the other way and hits your stop loss. That's trading for you.
So, to help you avoid those traps and use this pattern effectively, let's put everything we've talked about into a simple, straightforward checklist you can use every time. Before you even think about placing a trade, just quickly run through this in your head. Is there a clear trend? Check. Is P1 long and P2 small? Check. Is P2's body inside P1's? Check. Are the colors right for the pattern I'm looking for? Check. And most importantly, do I know exactly where my stop loss is? If you can tick all those boxes, you're in a much, much better position.
The Harami is a fantastic tool to have in your trading toolbox. But remember, it's just one piece of a much larger puzzle. Mastering it is a huge step, but it should get you thinking, what other signals is the market sending out that I might not be seeing yet?